Welcome back to the deep dive. If you've been keeping an eye on the financial news, well, you know where the action is. The crypto market is, let's just say it's absolutely on fire right now. Bitcoin hasn't just climbed, it's hit new all-time highs. And a lot of that seems to be driven by this wave of institutional money coming in through those new spot ETFs, right? The floodgates really feel open. But today, we're actually going to shift focus a little bit away from Bitcoin itself.
That's right, because while, everyone's watching the BTC price, there's this other layer that's showing incredible strength. It's almost like a leveraged play on Bitcoin. We're talking about the Bitcoin mining stocks. And what's happening there is, frankly, astonishing. We're not just seeing small bumps. Some of these companies, their stocks have rallied 20, 30, maybe even 50%.
In just a week. 50% in a week. Wow.
Yeah, it's wild. And this signals a really deep, renewed investor confidence, not just in Bitcoin, the asset, but in the actual infrastructure that powers the network. The plumbing, if you will.
Okay, so that's our mission for today then. We're going deep on why. Why are these mining stocks pumping so hard? Often even harder than Bitcoin itself. We'll get into the mechanics behind that leverage, what this whole rally tells us about maybe the sustainability of this bull run, and crucially, how these companies are changing. They're not just miners anymore, are they? They seem to be evolving into something bigger, more complex.
Yeah, diversified energy, data infrastructure. It's a fascinating shift.
So stick with us. This is basically your shortcut to getting up to speed on a really exciting, high leverage, high risk part of the crypto world right now. Okay, let's unpack this core idea first. Bitcoin's going up. Fine, we see the ETF money. But why do the miners often do even better? What's the actual mechanism behind this leverage?
Right. It really comes down to their basic economics. It's about operational leverage. Think about it. A miner's biggest cost, overwhelmingly, is electricity. Yeah, powering all those machines. Exactly. And that cost, while it can fluctuate, it's largely, somewhat fixed or at least predictable based on their contracts. It doesn't instantly jump just because the price of Bitcoin doubles overnight.
Okay, so if they locked in an energy rate, say 4 cents per kilowatt hour, that stays the same whether Bitcoin is $50,000 or $100,000.
Pretty much, yeah. Or at least it doesn't scale directly with the Bitcoin price. Let's run some quick numbers just to make it really clear, because this is where the magic or the leverage happens. Imagine a miner, a pretty efficient one, costs them, say, $25,000 all in power, cooling, staff, whatever, to mine one Bitcoin.
Okay, $25K cost.
Right.
Now, scenario 1, Bitcoin is trading at $50,000. Their profit is simple math. 50K minus 25K cost. That's $25,000 profit per coin. Solid margin, 50%. Makes sense. Okay, now scenario 2. Bitcoin rallies, goes up 50% to $75,000. What happens to their cost? Still $25,000 based on what you said.
Exactly. Still $25,000. But their revenue is now $75,000. So their profit is 75K minus 25K, which is $50,000 per coin.
Yeah. Ah, I see. Bitcoin went up 50%, but their profit doubled, went up 100%.
That's the leverage. A 50% jump in the underlying asset leads to a 100% jump in profit. That's why these stocks are called high beta. They amplify the moves, and that's what's pushing their profitability sky high right now, even when you factor in the reduced block rewards from the recent halving, which we'll definitely get into. Okay, that leverage mechanism is clear now. It's that gap between relatively stable costs and potentially explosive revenue. So beyond that core economic engine, the sources we looked at identified like 4 specific things fueling this current surge. Let's maybe tackle those one by one, starting with the obvious one, the ETFs. Yeah, driver 1 is definitely the ETFs. The sheer amount of money flowing in there, it's not just lifting the Bitcoin price, it's changing the whole perception of crypto. And for big institutions, buying shares in, say, Marathon or Riot is just easier. It's a regulated stock. They don't need to worry about setting up wallets, custody, compliance hurdles with holding actual Bitcoin.
So the miners become the simple proxy play for them.
Exactly. It's a compliant, easy way for huge funds to get that leveraged Bitcoin exposure.
Okay, driver 2 seems a bit more technical, almost counterintuitive. You mentioned hash rate stabilization. I thought hash rate always just goes up and up, making it harder for everyone. How is slowing growth good?
Yeah, it does sound odd, doesn't it? But think about it. The network difficulty adjusts based on total hash power. If new hash power floods the network constantly, the difficulty shoots up, and your existing machines earn less and less Bitcoin each day. You're on this treadmill, constantly needing to buy newer, faster rigs just to keep your share.
Right, the arms race.
Exactly. But if that overall hash rate growth slows down, maybe because of supply chain issues for new machines or energy constraints, Well, the difficulty doesn't rise as fast. Suddenly, the existing efficient fleets owned by these big public miners like Mara or Riot become more profitable for longer. Their current investment pays off better because the competition isn't increasing quite as ferociously.
Ah, okay.
So less dilution of their mining power, essentially, in
Yeah.
a sense. Which leads nicely into driver 3, institutional reentry, but specifically choosing these stocks.
Yeah, it's closely related to the ETF point, but distinct. We're seeing big investors actively choose mining equities. They view a company like CleanSpark or Hut 8 as a business they can analyze, look at their balance sheet, their management, their energy contracts. It fits their models better. It avoids all the headaches of direct crypto custody, which for a massive pension fund can be a significant operational and legal challenge. They want regulated, familiar structures.
Compliance is key for them.
Massively. So mining stocks are the path of least resistance for a lot of that institutional capital wanting Bitcoin exposure. And the fourth driver, this sounds like it's about the miners themselves getting smarter, improving operations, especially with energy and, interestingly, AI.
Yeah, this is where you see the real maturation of the sector. They're not just passively mining anymore. They're actively managing energy, striking clever deals, sometimes even selling power back to the grid. And this AI angle, it's about diversifying revenue, using their infrastructure, their data centers, for more than just mining. When mining isn't as profitable, maybe they can lease that compute power for AI training or other tasks. We'll talk more about that, but it makes them look less like volatile tech stocks and more like resilient infrastructure companies.
Okay, fascinating. So it's a combination of Bitcoin's rise, easier institutional access, a slightly less competitive mining landscape for the big players, and the miners themselves getting much more sophisticated operationally.
That's a great summary. It's all those things working together right now.
All right, let's get into something that feels like a paradox. The halving. It happened recently. Cut the block reward from 6.25 Bitcoin down to 3.125. Basic logic says cutting your primary revenue source in half should be bad, maybe even disastrous for miners. But you're saying they're thriving? How does that work? How does the halving actually end up helping the survivors?
Yeah, it's the million-dollar question, isn't it? And the answer is simple, but powerful price. They are thriving despite the reward cut simply because the price of Bitcoin has gone up so much, it's more than canceled out the effect of getting fewer Bitcoin per block. So back to your earlier example, the profit margin increase from the price jump was bigger than the revenue hit from the reward cut.
Exactly. If your cost is 25K and the price goes from 50K to 75Ks, your profit per coin doubles from 25K to 50K. Even if you're now mining half the number of coins, your total dollar profit might still be higher than before the halving, purely because each coin is worth so much more, and the profit margin on each coin is wider. That leverage effect we talked about is crucial here. Okay, so the halving only works for miners if the market is already strong and the price keeps rising to compensate. It's a bet on continued appreciation.
It absolutely requires that bullish conviction. And if you look back historically, 2012, 2016, 2020 halvings, there's a pattern. Things might get tight for miners right around the halving, but typically in the 6 to 12 months after the event, as the supply shock really filters through the market, you tend to see mining profitability and their stock prices really take off.
So investors anticipate this pattern now. They see the halving not as a penalty, but as a prelude to a price surge.
Largely, yes. It's seen as this programmed supply cut. When that meets strong demand, like we're seeing from the ETFs, basic economics says the price should adjust upwards over time. Investors are betting on that historical precedent and the supply-demand dynamics.
But the halving does more than just impact price dynamics, right? It actively weeds out the weaker players.
Oh, absolutely. That's the consolidation effect, and it's maybe the most important long-term consequence. Think of it as a stress test. When revenue gets cut in half overnight, miners who were barely profitable before, maybe they had older, inefficient machines or really high electricity costs or too much debt, they just can't survive, they have to shut
You
down.
sort of drop off the network.
They drop up, their hash rate disappears. And what happens then? The remaining block rewards, the transaction fees, they get distributed among fewer competitors. So the efficient, well-capitalized companies, your Mares, your Riots, your CLSKs, the ones who prepared, who upgraded their fleets, secured good power deals, they end up with a larger slice of the pie.
So the halving forces consolidation, making the strong stronger. And that makes the remaining public stocks look even more attractive to those institutions we mentioned.
Precisely. Fewer, stronger players dominate the field. It cleans house. So when you see these mining stocks rallying hard post-halving, it's not just reflecting the Bitcoin price, it's also reflecting this improved competitive position. It's a strong signal, really. It tells you the market believes this bull run has legs and that capital is flowing into the core infrastructure, not just speculating on the coin itself. It's a vote of confidence in the whole ecosystem's foundation.
Okay, let's zoom in on some of the specific companies making waves. The sources point to a few leaders really standing out. What are they doing differently? What are the strategies setting them apart?
Yeah, execution is everything post-halving. Let's look at Marathon Digital, ticker MARA. They saw a huge jump recently, over 30%. Their game has always been about scale. They aim to be one of the biggest, if not the biggest, in terms of raw hash rate in the U.S.
And scale means, like, what kind of numbers are we talking?
Well, they recently blew past a major milestone, 200 exahash per second, EHS.
200 exahash. That sounds like a lot.
It is. An exahash is a quintillion hashes per second. So 200 EHs is just immense computational power focused on mining Bitcoin. It solidifies their position to grab a big share of those block rewards. But crucially, they know scale isn't enough. They're also pushing hard on efficiency, announcing plans for next-gen rigs, aiming to cut energy use by maybe 20%. In this environment, efficiency is profit.
Right, every watt counts when the reward is lower. Okay, what about Riot Platforms, Riot? They were up nearly 25%. Their story seems tied to Texas, doesn't it?
Very much so. Riot's big advantage is their setup in Texas and how they work with the power grid there, ERCOT. It's quite innovative. They essentially have deals where during peak demand times, like a crazy hot summer afternoon when everyone's EC is blasting, ERCOT can ask Riot to power down their miners.
To save the grid from overloading.
Exactly. And Riot gets paid for doing that. They receive power credits or demand response payments. So they actually generate revenue by not mining sometimes.
Wait, so their biggest expense, electricity, can become a revenue source?
Yes. It's brilliant, really. It gives them this alternative income stream that's totally unrelated to the volatile Bitcoin price. It helps stabilize their earnings and provides a service to the grid. Investors love that kind of smart energy management and revenue diversification. That is clever. Okay, next up, CleanSpark, CLSK. Sources say they're often outperforming even RA and Riot recently. What's their secret sauce?
CleanSpark is almost hyper-focused on efficiency. Their whole narrative is about being lean, mean, and getting the absolute most hash power per watt of energy consumed. They talk a lot about joules per terahash.
Okay, so optimization fanatics.
Pretty much. And they've been very aggressive in expanding their capacity, but strategically, focusing on places like Georgia where they can secure favorable power and build out efficiently. They're really capitalizing on the U.S. becoming the global hub for mining. It's less about being the absolute biggest, more about being the most profitable per unit of energy.
Efficiency and smart expansion. Got it. And beyond the big three, are there others worth watching? Hut 8, Bitfarms.
Yeah, definitely keep an eye on them. Hut 8, HUT, is interesting because they recently merged with U.S. Bitcoin Corp. That merger gave them a much bigger, more diversified operational footprint and a stronger balance sheet. Diversification reduces risk. And Bitfarms, BITF, is positioning itself as a really low-cost producer. They focus on finding the cheapest power sources, managing their spending super carefully. That makes them more resilient if the Bitcoin price dips or stays flat for a while. Being the low-cost leader is a strong strategic position in any commodity business, and mining is, in some ways, becoming like that.
So different strategies, but all focused on efficiency, scale, or smart energy plays. It's definitely not a simple business anymore.
Not at all. It's sophisticated corporate strategy applied to blockchain.
So this really hammers home the point that mining isn't just, geeks in a basement anymore. These are serious companies transforming into complex infrastructure players. What's really driving this shift towards, institutional acceptance and these innovative energy and data models?
Well, a big part is still that institutional preference we talked about. For a pension fund or an endowment, buying stock in Riot is just worlds easier from a compliance and custody standpoint than buying and holding actual Bitcoin. It fits their existing workflows.
They want regulated, easy-to-handle exposure.
Exactly. They see these companies as, potentially cash flow generating businesses in a high-growth sector, all wrapped up in a familiar stock format.
But this hybrid model idea, especially integrating AI workloads, that feels like the really game-changing part. How does a Bitcoin miner suddenly become relevant to the AI boom?
It sounds like a leap, but it makes a lot of sense when you think about their core assets. What do miners have? They have buildings full of powerful computers, specialized, yes, but still compute power. And crucially, they have access to large amounts of electricity, often secured at competitive rates.
Okay, compute and power, the two key ingredients for AI too, though.
Precisely. AI training, running complex models. It's incredibly energy intensive. and needs massive processing power. So the idea is, during times when Bitcoin mining isn't super profitable, maybe the price is down or difficulty is way up, miners could potentially switch gears. They could reconfigure some of their hardware or lease out their data center space and power capacity to companies that need it for AI tasks, high-performance computing, rendering, you name it.
So instead of machines sitting idle or mining at a loss, they flip them over to service the AI industry and generate revenue that way.
That's the vision. It's about maximizing asset utilization. Why let expensive infrastructure sit underutilized?
Yeah.
We've already seen some companies exploring this, like Core Scientific and others looking into renting out capacity. It fundamentally de-risks their business model. They're not 100% reliant on the whims of the Bitcoin market anymore. They become more like a versatile tech infrastructure provider.
That makes them a much more compelling story for long-term investors, I imagine. Less pure crypto play, more diversified tech.
Absolutely. And it also ties into the whole sustainability narrative, which is increasingly important, especially for attracting that institutional money.
How so? The energy consumption is still huge, isn't it?
It is, but the narrative is shifting. Firstly, miners are under immense pressure to use renewable energy sources. Solar, wind, hydro. It's almost becoming table stakes to attract ESG-conscious investors. Secondly, those grid partnerships, like Riots in Texas, they position miners not just as energy consumers, but as potential grid stabilizers. By agreeing to power down during peak demand, they're helping balance the grid. They can absorb excess renewable energy when it's plentiful and provide relief when the grid is stressed.
So they go from being seen as a part of the energy problem to potentially part of the solution.
That's the angle, and it's a powerful one. It changes the perception. They become partners in the energy transition, leveraging their unique capabilities. It's a much more sophisticated, mature image for the sector.
Okay, this all sounds incredibly positive: growth, innovation, institutional buy-in. But we need to inject some reality here. This is still crypto adjacent, known for volatility. For you, the listener, considering the space, what are the big risks? What's the flip side of this exciting story?
Yeah, absolutely crucial to cover the risks. First and foremost, volatility. We mentioned miners are high beta. That leverage cuts both ways.
When Bitcoin flies, they can fly higher. But if Bitcoin drops 15, 20%, well, don't be shocked if your mining stock drops 30, 40, even 50%. They amplify the downside just as much as the upside. You have to have the stomach for that kind of swing. So rule number one, expect extreme volatility. Beyond market swings, what about their actual operations? What keeps these CEOs up at night? Well, competition is always there. That hash rate stabilization we talked about. That could change if suddenly lots of new super efficient machines flood the market or new large-scale miners come online unexpectedly. That increases the difficulty and squeezes everyone's margins again. It's a constant technological race.
The arms race never really ends. Never truly ends. And the other huge operational risk, the perennial one, is energy costs. That's their single biggest line item. Even with good contracts, power markets can be incredibly volatile. Think about natural gas prices swinging wildly, or regulatory changes impacting energy costs, or even just extreme weather events disrupting supply. A sudden spike in their power costs can crush profitability, even if Bitcoin's price is stable.
So energy price risk is fundamental. And what about the R word? Regulation.
Always a factor in crypto, isn't it? While the U.S. has become a dominant mining hub, which offers some stability, you never know what might come down the pike. Could there be new taxes specifically targeting mining profits? Stricter environmental rules imposing costly upgrades or limiting operations? It's an evolving landscape, and a sudden regulatory shift could definitely impact growth and valuations.
Okay, so high volatility, relentless competition, energy cost uncertainty, and regulatory risk. It's definitely not a set it and forget it's investment.
Not even close.
So wrapping this all up, what are the key takeaways for someone listening? If they're intrigued by this space, how should they think about it strategically? Okay, first takeaway. Understand why you'd own these stocks. If you want aggressive, leveraged exposure to Bitcoin's price, and you want it in a regulated stock format, miners offer that. But know you're taking on significantly more risk than just holding Bitcoin directly. Leverage means higher risk, higher potential reward.
Don't put all your eggs in this one basket. Given the volatility, it probably makes sense for most people to blend mining stocks with maybe some direct Bitcoin holdings or Bitcoin ETFs. Diversify within your crypto allocation to smooth out the ride a bit.
Makes sense. Balance the high beta play. Third, and this is critical, you have to monitor the underlying mining metrics, not just the Bitcoin price. Keep an eye on the global hash rate trends, watch the network difficulty adjustments, they happen about every 2 weeks, and try to understand the energy market dynamics where your chosen miners operate. Those factors directly impact their bottom line. So do your homework beyond just the stock price.
Absolutely. And the final takeaway, the big picture view. This rally signifies something important. It shows the market is maturing. Capital is flowing into the foundational infrastructure of crypto, not just speculating on price. Institutions are valuing these companies as potentially durable, essential parts of the digital economy. That's a significant shift.
Absolutely. And the final takeaway, the big picture view, hashtag tag outro. Well, that was definitely a deep dive. We've covered the mechanics, the players, the risks, and the evolution of Bitcoin mining stocks from simple coin diggers to these complex, leveraged, and increasingly diversified infrastructure companies.
Yeah, driven by that institutional cash and really reshaped by the halving dynamics.
And it leaves us with a really interesting thought to ponder, doesn't it? This whole hybrid model thing.
Right. If these mining companies get really good at integrating AI workloads, switching their compute power back and forth based on what's most profitable, Bitcoin mining one day, AI processing the next, could they, down the line, actually become more valuable as flexible data center providers than purely as Bitcoin miners? It kind of changes their whole potential valuation, their whole identity, doesn't it? Something for you to definitely think about and explore further.
A fascinating question for the future. We really hope this breakdown gave you the detailed insights you need to understand this dynamic sector. And hey, if you did find this valuable, if you appreciate us going granular on these topics, maybe take a quick second right now.
Mhm.
The drill hitting likes, subscribing, maybe clicking that notification bell.
Yeah.
It genuinely helps the channel a lot.
Yeah, it really does boost us in the algorithms, helps more people find the content, and frankly, it supports us being able to keep digging deep and creating these analyses for you each week.
We appreciate you tuning in. Thanks for joining us on the deep dive.